DeFi and crypto can be like the Wild West, full of both promises of riches, but also peril. But how can you separate those riches from fool's gold? In this video, I'll walk you through how to assess new DeFi protocols on Solana. Welcome back to the DeFi 101 course. This course is made with support from the Solana Foundation and is designed to take you from a crypto investor to a crypto user. You can find a link to the full course playlist, as well as supplementary written materials in the video description. Now let's get into it. First, what are we really assessing? When you assess a DeFi project, you're asking, if I put my money here, what's my risk and what's my upside? It's no different than sizing up a bank product, a financial app, or a new stock, except DeFi-based applications run on a blockchain using smart contracts. On Solana, that code executes fast and cheap, and Solana has, as a result, attracted many of the highest quality apps in the industry. But like everything in crypto, nothing replaces scrutiny. Your job is to understand three things. First, how a protocol works. Second, where your risk is coming from. And third, what might make it grow or shrink or fail. If you get these right, you're already ahead of 99% of participants. Start by breaking down what the protocol actually does. Is it a decentralized exchange? Is it a lending market? Is it a yield strategy vault? A liquid staking provider? Each of these products is going to have their own use case and things you need to assess. Ask what's the user doing and what is the protocol doing behind the scenes to enable the user to do that. Here's an example with Kamino's Multiply Vaults. This is a product from Kamino, and users deposit SOL. Kamino then borrows USDC against that SOL as collateral, uses that to buy more SOL, and then repeats, depositing it back into the pool until it's created leveraged exposure to Solana. This is an example of a product on Kamino that's driven usage towards Kamino's application. And that's great. If SOL goes up, risky if it drops. By the way, we covered this all in more detail in another video in this DeFi 101 series. Now, the reason I shared this example is it's an example of the sort of product you would need to understand before you ever touch the UI or considered investing in that project. The next thing you have to do after you understand what the protocol does is look at all of its risk vectors, since half the game is just avoiding risk. Let's break them down. First, you have smart contract risk. Smart contracts are risky. Over $6 billion has been hacked from DeFi over the years. But asking a few simple questions can help you alleviate these risks. Is it audited? Audits don't eliminate risk, but they do reduce it. Is it open source? Open source means that the code is available for the public to scrutinize. How long has it been live? Protocols that have been live longer have been more battle tested. New code can be powerful, but it can also be dangerous. A polished front end does not mean a secure back end or the logic that underpins that back end. You also have oracle and price feed risk. On Solana, most projects rely on oracles like Pyth. If an oracle is wrong or manipulated, everything from liquidations to trades can go bad. Check the various security features the protocol has in the backend, like circuit breakers or multiple feeds, to reduce this risk or reliance on a single oracle. Also look at the token design risk. Does the token have real utility like governance, fee sharing, or insurance backing, or is it just a normal farm and dump emission? Reflexive tokens can supercharge growth, but also supercharge collapse. Also look at liquidity and exit risk. Sometimes APY can look attractive until you lose the ability to sell the underlying token. Finally, look at liquidation risk. If you're using leverage, always know your health factor, because liquidations do happen and crypto is extremely volatile. If SOL were to suddenly drop 10% in 10 minutes, make sure you have time to react. Another thing you have to consider is just the risk of straight up bad management. Sometimes the underpinning tech is good, and there's no real bugs or failures, but it's mismanaged. So to understand that, you need to look at the team behind the project and assess both their experience, whether they can deliver on what they're promising, and whether they're trustworthy in the first place. Next, you want to understand the usage of the protocol. Are people using it? And you don't need to be a dev to do this. You just need to know where to find the right data. Some key metrics to check. The total value locked. That's how much capital is deposited in the protocol. Revenue. Is the protocol actually making money? Volume. For decentralized exchanges or marketplaces, this tells you how active is it, how many people are trading. And then understand the APY versus the risk. If you're looking at a yield-based protocol, are the yields sustainable, or are they likely to crash in the future? If you're getting exposure to tokens, you also need to make sure you check the token emissions. Many protocols start with low float and have high dilution later. Some tools that you can use are DeFi Llama, Solana.fm, and project-specific dashboard like Kamino or Jupiter. Not all projects are isolated. You also need to look at their position within the ecosystem. Ask questions like who integrates this project, and does it touch core infrastructure like Jupiter, Jito, or stablecoin roots? Is this part of a larger strategy and organization, or is it just a standalone app that maybe someone built as a side project? For example, yield protocols often integrate into many other protocols on the back end. This means that you're exposed not just to the core protocol, but to all of those integrations as well. As for the team, some questions you can ask are they doxed or anonymous? Anonymous teams can be great, but it is a risk factor. Have they shipped consistently in the past? Do they communicate clearly on Twitter or Discord or forums? Lack of communication by a team can be an early red flag that something is amiss. You don't need to join every team's Telegram or Discord group, but you can check it out to scan the vibe and see how the team reacts when things go wrong. If they hide, major red flag. Crypto is risky, but we've given you some tools to assess that risk yourself. If you want updates on the best yield opportunities, deep dives, and weekly crypto breakdowns, head over to newsletter.dynamodefi.com. And for more tutorials like this, be sure to like, subscribe, and check out the rest of this DeFi 101 course. Until next time, this is Dynamo DeFi.